So these numbers here are through the first 6 months of the year data, okay? So this is tech, on the left side is tech IPO aggregate market cap created, right? Aggregate market cap created via the IPO process per year. So if you look at 2019, that's a year-to-date number, that stands out, right? Especially after a healthy 2018. If you look at the right-hand side, in terms of aggregate proceeds from IPO, again, this is just tech, you can see that we are on record pace. And more importantly, if you look at 2012, that $22 billion had $16 billion of Facebook in it. So if you take out Facebook, it was actually a below normal year. And in that context, the last year, even 2017, 2018, and year to date, shape up to be like record-breaking years in terms of being a good time to go public. And it just so happens there are over 300 companies in the private realm who have been already valued at $1 billion plus. It's almost 350 actually on a global basis. Okay, so what are the board of directors of all of these companies doing right now? They're saying, call the bankers, go, it's time to go public. If you look at what's coming our way, look at slide 13. Half of these unicorns are US based, 25% are Chinese based. So if you're a fund that focuses mostly on domestic, you don't buy a lot of international stuff. By the way, some of the Chinese stuff will list on the NASDAQ, but let's assume it doesn't. You're still getting 172 new unicorns coming public over the next 2 to 3 years. Let's say half of them are successful enough to go public, right? So that's 85 of them. So you have a lot of new creation coming. If you look at on the right-hand side, and by the way, these are still mostly within tech. This is like, when it says like healthcare, it's like tech for healthcare. On-demand services are things like, well, Lyft already went public, but in that category of on-demand delivery. SaaS software, that's traditional SaaS software. Look at that category. It's over $32 billion plus SaaS unicorns ready to go public in the next 2 to 3 years. Guess what? The people who follow SaaS today, the universe is like 30 names. I don't know, maybe it's 40 if you stretch it. So you're going to double the size of the universe over the next 3 years. Now, this is very exciting for me because I've done a lot of, our tech team, because we've done a lot of IPOs, and some of them have been really fun. But I want to explain like where the bad news is in that. I wouldn't even call it bad news. I would call it just kind of like, maybe like what we do here. Yeah, this is like if somebody said to me, hey, what would you say you do here? I'd probably pull up the next slide, slide 14. This is the story of Pluralsight. The company went public as part of this software move, because everything I'm showing you, by the way, is already like 1.5 years old or 2 years old. So this stuff is already in process. You've got a lot of new company creation already coming through, especially in software. So here's Pluralsight, comes public, and people buy in, lots of people buy in. It's over a $4 billion market cap in this whole healthy period of time, right? People are buying, people are talking, people are investing, people are learning. The sell side are covering. It's the same sell side who were on the cover of the IPO and the secondary and the convertible raise, and maybe one of them also represented them on their recent M&A done in the first half of this year. You see where I'm going with this? And people buy in. Okay, people buy in. Why? Because you're getting, even until March, you're getting better than 40% overall billings growth and over 46% billings growth in the key B2B area, by the way, for 10 to 15 times revenue. And if that sounds like a lot, 10 to 15 times revenue, in the current context, it's not. Medulla oblongata is trading around 20 times revenue, and that's a much crappier company than this. So you're getting it. So people are looking at, they're like, oh, I can get this much growth for that much value. I can live with that trade-off. So people go for it. Problem one, slide 15. It wasn't or isn't a software company. It's a content company. This was the first point that we discovered in our review, where at first we thought either we're crazy or everyone else is crazy. And usually in those moments we assume it's us. I mean, literally, this is the company pitches itself as a software company, talks about itself as a company. Most of the clients talk about it as a software company. It's valued as a software company. It's covered by equity research analysts who cover software. This was a really weird moment for us. Then we saw, if you look at slide 16, this data wasn't available to everybody on the IPO. It wasn't available to public equity investors. This is stuff that we found on our own. This is the company itself presented the 2016-17 figures, and we filled in 15, 14, 13, 12, and 11, right? This is kind of what we do. And what we saw in that period was there was a significant deceleration in the billings growth, right? From 220% down to 15% billings growth over that time frame, right? And what was the company's reaction? Company's reaction was to go out and do a bunch of M&A, which helped them with the next reacceleration period. Well, guess what? As we were learning, we saw this, and we saw the fact that the company, as I mentioned a minute ago, raised $600 million earlier this year in a convertible offering to go and pursue M&A, which is one of those head scratches. You're like, okay, hang on a second. You're growing better than 40% year over year, better than 46% year over year in your core area, and you're already queuing up $600 million to go do M&A. And it wasn't like they raised the money to go do a single deal that they were like actually after, right? Which maybe would have made sense. It was like, we're going to raise the funds so we can go do M&A. It's kind of a little early for that, right? I mean, it's a little strange. But in light of this data, you're like, oh, wait a second. Last time when things slowed down, they went and did M&A. Are they seeing a slowdown that we're not seeing yet? Then the next thing we saw on slide 17, this is the one that really got us in trouble. The left-hand side's bullish. It's actually their land, how many dollars of customers that they were able to land in that Fortune 500 category in 2018. But the right-hand side is the implied expansion in dollars of their Fortune 500 customers who were customers before 2018. So their most important category of customers, once they've landed, is growing 2% per year. Is that even possible? Or is it a mistake in the S1? Now, this one got us in trouble. It got us cut off from the management team. They cut us off. End of story. They wouldn't talk to us anymore. They claimed we were making things up. It just comes from their S1. And we showed it when we presented in June. We went through it exactly how we calculated it. There was no secret. There was no surprise. There was no unique data. It came right from their comparison of their two S1s, the IPO and the secondary. So what they answered to their clients after we presented was that from 2017...
Their investors.
To their investors, to our clients. Yeah. What they answered to our clients, their investors, was, and the investment community broadly, thanks Darren, was that the 25 companies, that the composition of the Fortune 500 changed from 2017 to 2018. There were 25 companies, and that was their answer, full stop. So we were like, okay, that doesn't sound right. Well, it turns out there are 25 companies out of the Fortune 500 who fell off as we entered 2018. 15 of them for M&A reasons, 10 of them were acquired by other Fortune 500 companies, and 10 of them just fell off, right? And so what they implied to their customers, to their investors, our customers, was that the average price that those 25 companies were paying, the ones who fell off the Fortune 500, the average price that they were paying was what this implies. They didn't explain this. This is the math that we figured out. It was that those 25 who fell off were paying double the price of what their other Fortune 500 customers were paying. Now, either that's really convenient and true, or yet another error and an obfuscation. So this is a classic situation. And then we went a little bit further than that even. Slide 20, the company had done a couple of price increases. We stripped out those price increases from the adoption number, and look what we found. We found actually a decelerating curve of billings on the core B2B side, right, from 42 to 37 to 32.5, underneath what they were reporting. And guess what they reported in June that blew the stock up 40%? This line item fell to 26.5%, meaning from 48.4 to 26.5% in the June quarter, which if you had seen our slide before, maybe that actually kind of makes sense, because the benefit of the pricing thing lapsed. They lapsed the pricing impact in the second quarter. So they had no more protection from pricing. That was it. They had gotten as many people up onto the new SKU as they could, and that was it. So they were sort of naked, just adoption growth, and boom, you had a massive fall off in B2B, and so on and so forth. That is what we do. When we go deep dive, we go after this in every single way that we can, both long and short. We go in with an open mind. We find what we find. I mentioned Medallia a minute ago, so I'll just show it one last slide, which is slide 21. The top section is what Medallia showed in their S1, right? This is a 20-year-old, almost 20-year-old company, won their first major customer back just after 9/11, and they showed 2 years of financials. So we were like, oh, that's fishy. So we've decided to fill in the rest, which is the bottom left. And you can see from that there's been decelerating revenue growth, both on percentage terms and on dollars of incremental revenue terms. And so this is what we do. The fact that there's 300 plus unicorns going to go public over the next 3 years and 170 in the United States, and of which at least 30 directly in the SaaS software space, that's excluding the big data names that were on there, the BI and analytics, which are also all software. I mean, it's like a massive amount of software companies coming public over the next couple of years. There'll be some great ones. There'll be some ones you really want to own. In the beginning, there's like an excess valuation because we've got excess liquidity. This will soak up that excess liquidity. Along the way, the valuations will start to make sense. By the end, they'll actually look kind of cheap. But along the way, the bankers are definitely going to try to like slip some of these by you. And that's what we do. We look for all that stuff they're trying to slip by you.